Hey guys, welcome back to Father and Son Investing. This is going to be the April update for Treasury bills, Treasury notes, and Treasury bonds. I realize I'm a little bit late into the month. We've been pretty busy around our place moving into a new home. So what I'm going to do with this video is we'll talk about Treasury bills first. There's not a lot happening with Treasury bills, but there is some movement in the 6-month and the 12-month Treasury bills. So we'll talk about Treasury bills first and what we can expect there, particularly some information for April that you may not have. I realize there's only half the month left, but we'll talk about that. After that, we'll get on to Treasury notes and bonds. There's a lot more happening there, and I've got a lot of good information for you when it comes to Treasury auctions, when it comes to what's happening with those Treasury auctions, particularly with foreign investors. We're also going to talk about what's happening with the Fed's balance sheet runoff, because there may be some action happening there in the near future that could affect Treasury note and bond yields as well. Lastly, at the end, I'll give you my take for where I think bond yields and bond note. Lastly, at the end, I'll give you my take for where I think note yields are going and bond yields are going. So let's get started. All right, let's just start with Treasury bills and take a peek at what's been happening there. So this is the year-to-date 1-year Treasury bill, and you'll notice this nice kind of steady incline. This particular steep peak here happened after the inflation data came out. It's since retreated just a little bit. So if you're looking to get a 1-year Treasury bill, now might be a good time. This actually peaked just here above the 5.2% range, and keep in mind that that Fed funds rate is in that 5.25 to 5.5%. So it's approaching that Fed funds rate on the 1-year. That's actually pretty good. The other place where things have been moving has been the 6-month Treasury bill. And again, we see that it's just kind of making a steady climb here in its yields, meaning the prices have been dropping. When it comes to some of these other ones, they really have just been hovering around a narrow range, somewhere in the middle of that Fed funds rate, which is really what you would expect on the 1-month bill there. I want to show you this because this could affect some of the Treasury bill yields during the rest of the month. This article here from Bloomberg: Wall Street sees fewer T-bills sold in April as tax season boosts U.S. cash pile. So with all of this revenue coming in to the Treasury, people paying their taxes by April 15th, you'll see that here in red, it's essentially their checking account here is projected to get up near $1 trillion. And as they have that much money in their checking account, this is the Treasury general balance account, or general account balance if you want the formal name for it, but think of it as their checking account. As it gets close to that $1 trillion, they're going to need to sell fewer short-term U.S. Treasuries, see that as Treasury bills. So that may affect some of the Treasury bill yields as the volume of those Treasury bills comes down. Now, they've actually been artificially high because the Treasury has been trying to sell more bills and fewer notes and bonds, trying to keep the yields down on those notes and bonds. All right, well, that's all I have for you when it comes to Treasury bills. Hopefully, you'll want to continue on and watch some of what's happening with the notes and bonds and with the U.S. Treasury market in general. So I mentioned the inflation data coming in. Here's the headline from the Wall Street Journal: Hot inflation report derails case for Fed's June rate cut. Now, remember, at the beginning of the year, we thought that there was going to be a rate cut in March, and then again in May, and again in June, that people were anticipating potentially up to 6 rate cuts, although the Fed had really anticipated only 3. So let's take a peek at what's happening with these potential rate cuts now. You can get an idea of what the market thinks will be happening with rate cuts from this CME Group Fed Watch tool. And you'll see that for May, they're essentially thinking the Fed is not cutting. 94.1% chance that rates stay between that 5.25 and 5.5% range. But let's just take a peek at what it looks like now for June, and we'll see that really they're still thinking the odds are that there won't be a rate cut in June either. And in fact, really it's not until out into July where it starts to look kind of 50-50 that there may or may not be some rate cuts going on. However, let me show you this article from Bloomberg that appeared on April 11th. Bond traders shift thinking to 5% yield. This is on the 10-year that we're talking about, the 10-year Treasury note. 5% yield potentially with no rate cuts coming at all this year. So there are some folks out there who are anticipating that we might not see any rate cuts this year, and thus these yields are going to be staying up or really climbing, with the 10-year getting up to 5% potentially. Now, that would be a significant increase from where we're at right now. You'll see here that the 10-year note currently is at 4.5%. It almost touched 4.6% the other day when that inflation data came out. Now, why might we be seeing 10-year Treasury note yields hitting that 5% mark again, which they haven't done since really last October, when bond yields were climbing significantly after the Treasury announced their massive Treasury auction for that quarter back in August. Well, let me show you this headline from Barron's talking about Treasury auctions here. This is one reason why those yields may get up to 5%. U.S. Treasury auctions come under scrutiny after inflation data. What is going on with these Treasury auctions? Well, here's the article from the Wall Street Journal talking about the 10-year Treasury auction. It did not go well the other day. You'll see here it says weak demand. We're going to delve into the numbers even closer here in just a minute. But it is not just the 10-year Treasury note that was having difficulty with the auction this week. In fact, look at this article from April 9th talking about the 3-year Treasury note. Again, met with weak demand. In this case, the auction tailed by 2 basis points. We're going to talk about that more here in a minute. I've talked about it in the past, but I'll give you a refresher. And the bid to cover, we'll talk about that as well, was lower than in the previous auction. So we've got the 10-year, we've got the 3-year. How about the 30-year? Well, here's an article from Bloomberg for the 30-year bond auction that took place this past Thursday. Highest Treasury yields of year failed to tempt buyers to auction. Fewer buyers of the dip after long-dated yield surge over 4.5%. Now, I don't have a subscription to Bloomberg, so I can't show you this whole article, but this gives you an idea. The 3-year Treasury note, the 10-year Treasury note, the 30-year Treasury bond, all of these auctions have not gone well recently. Now, we're going to dive more into the 10-year Treasury note results, but I want to give you just some background here so you'll understand what I'm talking about. So the first thing you need to realize is that after the Treasury announces an auction, trading starts taking place on this future auction that's going to happen. And we call this the when issued trading activity. It takes place from the time of that announcement to when the auction is essentially starting. Realize that there's a lot of people in the background trading on this Treasury auction. We'll just say the 10-year Treasury note. They're trading on a future 10-year Treasury note and where they think the auction results will come in. So keep that in mind. So there's a few things we're going to look for when it comes to these Treasury auction results. Now, that when issued market that I just talked about, they're going to have something that we're going to call the snap price. That's going to be where they think that the auction results will come in at. Now, if those auction results come in such that the government is having to give more yield, meaning the price is lower than what they thought that snap price would be, that's going to be what we call a tail. So a tail is when the government is having to sweeten the pot a little bit with extra yield to get people to purchase their U.S. Treasury. So this is kind of an old graphic here. You'll see it's from 2014, but it makes the point. You can see here tail basis points. All of these are pretty small. So what is good or bad? Well, 1 basis point would be great. Anything less than 1 basis point is fantastic. 2 is okay. 3 is okay. 4, 5, or 6 means that the Treasury market it's broken. Something's wrong in there. Now, this is only just a few basis points. This is not very big, you might think, but these guys are really good at trying to come up with what they think the price will be. So when that tail reaches 4, 5, or 6, that's a disaster. 3 is really not that great. We'll also look at the bid to cover. And bid to cover can perhaps best be explained by going to the actual Treasury auction results page from the treasury.gov website. And essentially what we'll see here down at the very bottom in this tiny print, it says bid to cover, and it gives you a ratio 2.34. And essentially it was how many dollars were bid versus how many dollars were accepted. Now, each of these we really need to be able to compare to what previous auctions have looked like in order to know whether these are good or bad. With all of that in mind, then, let's narrow in on this 10-year Treasury note auction, the $39 billion that we just saw from that auction results page that I showed you. So according to this author, the auction was simply disastrous. And let's get down into the weeds here when it comes to what did things look like the tail, and how about the bid to cover, and compare that to what it's looked like in the past. The tail, okay, it tailed the when issue market by 3.1 basis points. Remember, 3 is not that great, 4, 5, 6, that is a disaster. So we're not quite to the disaster range, but this is not good. But we need to be able to compare to what that has looked like in the past. So let's take a look at that. This was the largest or the longest tail, meaning the highest basis points since December 2022. So this was not great. Let's go ahead and look at the bid to cover. I just showed you that on the auction sheet, but 2.336. And this was also the weakest since December 2022. So that gives you an idea of what this auction result looked like. But let's look closer at where the actual 10-year Treasury notes got auctioned to, meaning who purchased them. So let's go ahead. Indirect bidders. Think of these as foreign bidders, okay? They took down just 61.8% of the issuance. I have an article that's going to talk about this more here in just a minute. And then let's go ahead and look at the direct bidders. These are the domestic accounts, 14.2%. Now, that was the smallest share for U.S. accounts of any auction since November of 2021. So even worse than these numbers up here going back to December of 2022. Now, when this happens, the foreign bidders get theirs, the domestic bidders get theirs. There's a group of entities called the primary dealers. Think of these as really big financial institutions or insurance companies. And so they get stuck with having to take whatever's left over in the auction. That's just the way the government works this for these primary dealers. So how much did the primary dealers have to take home? 24% of the auction. Now, how does that compare to the past? Well, that's the worst since November of 2022. So all of this is not looking good for this 10-year Treasury note auction that just took place, and this is going to have a big impact on my prediction at the end of this video. Now, I mentioned just a minute ago that the foreign demand was down for this U.S. Treasury note. Here's an article in the Financial Times that talks about this. This is from April 9th. Big investors buy European bonds over U.S. Treasuries as economies diverge. So we're starting to see some of these big investors out there looking to buy European bonds and not necessarily looking to buy U.S. bonds. Now, this is not just entities outside of the United States. You'll see in this article here, it says money managers at PIMCO, JP Morgan Asset Management, and T. Rowe Price have all increased their exposure to European government debt in recent weeks. So not only is the demand weak from foreign entities, but even within the United States, some of these big financial institutions are starting to purchase European government bonds over purchasing U.S. Treasuries. All of that leads us back again to bond traders shift thinking to a 5% yield and no rate cuts. Now let's talk about one thing that could dampen potential increases in those bond and note yields, and that is an article here in the Wall Street Journal from April 10th. Fed prepares slower pace of runoff for $7.4 trillion portfolio fairly soon. So what is this talking about? The Fed has essentially been letting U.S. Treasuries run off its balance sheet without replacing them with additional new U.S. Treasuries. What has that done? That has taken a lot of liquidity out of the market because the Fed is not buying these. They're forcing other people essentially to buy the U.S. Treasuries. So they're talking about sometime soon slowing this balance sheet runoff, meaning that they would start to repurchase some U.S. Treasury bills, notes, and bonds. So that potentially could keep some of the yields down. But what might that do if they start slowing that down? Well, obviously, they're going to then increase some liquidity within the market, and that potentially could drive inflation higher. So the Fed is going to be trying to do a balancing act here when it comes to this slowing of their balance sheet runoff. Now, before we get to some of my predictions for where I think that bond and note yields are going, I want to show you this webpage from the Atlanta Fed. Here they talk about sticky price CPI. And when they're talking about sticky price, just know that sticky means slow to change, meaning that this is a category of goods that generally does not increase or decrease their prices very quickly. Now that would be in contradistinction to essentially flexible CPI, and that would be a basket of goods where prices can change really quickly. So let's take a peek based on how this is broken down to look at some of these inflation numbers and get an idea of what inflation might be doing, because that really affects your bond yields. All right, what I have here first on the graph is just the 12-month sticky CPI, the goods that don't tend to change prices very often. And what we'll see is that these really took off, even though they don't tend to change much, they really took off back here. And then they have come down, but now they've kind of slowed down, and then look, they went up for the month of March. 4.5%. Again, this is still really high above what the Fed's target range is of 2%. But let's get an idea of, if we bring in the 1 month annualized, what did that look like? And we'll see that the 1 month annualized is actually higher than the 12-month annualized. So again, things here for the sticky prices, high. Now let's take a peek at the flexible. We'll go ahead and bring in the 12-month. For flexible, we'll see that that really went way higher as we would expect, and that was driving the inflation back there in 2022. And then it came down, it actually dipped below, and in a sense come back up. So what we have going on is that sticky goods CPI still higher than the Fed wants it, and looks like maybe taking a turn up. And the flexible, the ones that really change prices quickly, those are making an upturn as well, potentially. So we may see that the Fed has not really beat inflation here yet. And what might that do? Well, I at least saw some discussion that a Fed increase in that Fed funds rate is potentially in play now. So even though we looked at the CME watch tool earlier and it showed just holding steady for May, potentially we might even start to see a higher likelihood that the Fed has one more rate increase in store for us. So keep all of that in mind. All right, so what is my prediction here for the 10-year Treasury note? Well, I think that 5% by the end of the month is quite possible. I've told you in previous videos that I think that these yields are way lower than they should be. The Treasury is spending money like there's no tomorrow. In fact, look at this headline here, Treasury, 1.1 trillion deficit in first half of fiscal year. Now, initially, the estimate was going to be 1.6 trillion for the whole year, and we are at 1.1 trillion through the first 6 months. So potentially we're looking at 2 trillion or potentially more in deficit for fiscal year 2024. With all of that deficit spending going on, I think that people and institutions who are purchasing U.S. Treasuries should be able to demand more yield from the government. Likewise, I think for the 2-year Treasury note, I think this is going above 5% really quickly. In the past, 5% for me has been my threshold for where I would buy a 2-year Treasury note. That may actually go up a little bit higher before I want to buy, like maybe more like 5.3%. When it comes to Treasury bills, really those are going to just hold steady. As long as the Fed's fund rate stays the same, I think that the 1 month and 3 month and everything in between are not really going to do much. However, that 1-year Treasury bill, that may start to creep up a little bit higher still as we get closer to May and what may or may not happen with the Fed meeting there in May. So that's what I have for you for this update for April 2024. I hope it was useful for you. I hope you learned something new. If you did, please give us a thumbs up and let us know in the comments what you may have learned. Until next time, enjoy your investing.